What happens to an IPO when there is excess liquidity in the market? Well, logically, and as it has always been, stock prices hit the rooftop. But rarely has this phenomenon given merchant bankers a headache. So what's different now? What's different is the fact that with renewed HNI activity due to good macroeconomic factors and of course excess liquidity in the market, merchant bankers are having a tough time settling the IPO prices. Well, the companies that are trying to cash on the excess liquidity in the market by aggressively pricing their stocks are also taking a hit. That leads us to conclude that HNIs have found stock markets as their latest playground. We have our correspondent Ankit Doshi and assistant editor Ranjani Raghavan from Mumbai to help us understand the story better. With the macroeconomic situation leading to positive sentiment, a lot of liquidity is finding its way back to stock markets. And now with renewed HNI activity, the IPO prices are getting distorted. What exactly are your observations about these prices distortions during IPOs?
Usually what happens is that there is a process of price discovery that happens, which merchant banks managing the issue run this exercise by gathering investor feedback. They arrive at a price band based on the feedback, and usually they leave a room of around 15 to 20% upside for the investors. Now, what's happening is, based on this euphoric sentiment, prices are moving beyond their anticipation. And this we understand is because there is a significant uptick in inflows coming in from wealthy investors. These wealthy investors seem to be borrowing funds and increasing their exposure to public stocks. And this is creating an artificial sort of surge in many of these public listings when the stock makes its debut.
With the macroeconomic situation likely to stay this strong and stock markets being the preferred destination for investments as well, what do you think can be the long-term implications if this pricing distortion continues?
I look at it from various perspectives. Most bankers definitely are seeing it more challenging to price future IPOs. From the point of view that going forward you could have companies demanding more aggressive valuation. Assuming a price correction or a decline in secondary market, one could see a majority of the recent listings trading below IPO price, and that could actually backfire if IPOs are priced more aggressively. Also, from the point of view, you are going to see some very large IPOs lined up, as against the last 2 or 3 years where you saw IPO size ranging in about 500 to 1,000, 2,000 odd crores. You could see IPO size increasing going forward. And that could actually, reduce the speculative element in the HNI segment. And you could see, listing gains being more reasonable. That would actually bring down the influence of HNI distorting, IPO pricing and listing.
Alright.
It's a catch-22 situation in some way where, bankers are caught whether to price them more aggressively or not, keeping in mind various factors.
What happens to the upcoming IPOs amid these price distortions will be seen as and when these companies get listed. But one thing is for sure, that whenever these companies get listed, their stock prices will definitely be determined by the prevailing investment sentiment by the HNIs. Well, that's all that we have for you in this edition of VCC TV. Keep watching this space for more updates.